Now, market corrections and crashes are a staple to the market. They're going to happen. It's not if, it's when. So since 1900, there have been 125 corrections. Corrections are defined as a drawdown of 10% or more peak to trough. There have been 32 bear markets defined as a 20% drawdown or more peak to trough. So you're going to spend about 1/3 of your life in bear markets. Bear markets come along every 3 to 3.5 years. Corrections come along every year. Really good investors have learned to harness the power of the bear market to boost their returns for years to come. That's really what distinguishes an average investor from a great investor. So I don't know how many of you are familiar with this term, Homo economicus. But despite looking just a bit like my husband in college, it's actually an academic term used to define man as a perfectly rational wealth maximizer with the infinite capacity for rational decision making. I mean, do you think Homo economicus exists? I don't. And despite that, Homo economicus is used all the time in finance and economics. So most of Western philosophy and academia preaches Plato's mind-body split and the predominance of rational thinking. Students in business school are taught to calculate risk using standard deviation and beta, and Homo economicus really supports this model. But value investors say, no, we don't buy that. You know, intrinsic value often differs from price. Risk is simply paying too much for a security. And really, the returns bear this out. The returns support a value investor's perspective. Here we have a graph showing the 20-year annualized returns by asset class. And as you can see, stocks had returned 9.9%, bonds 6.2%, gold 5.8%, oil 5.6%, international stocks 5%, and homes 3.1%. The average investor, 2.5%. Now, how is that possible if all these asset classes outperform the average investor? It's because people are really terrible decision makers, and they're oftentimes buying high and selling low. Now, I'm a really good Southern girl, and I was raised on a diet of BLTs. But in my family, we called them Buffett, Lynch, and Templetons. These are three of the greatest investors and their track records, and they are remarkable. I think one thing to highlight is that Warren Buffett has an incredible vehicle for investing. Peter Lynch and Sir John both manage mutual funds. Mutual funds are terrible vehicles for the manager because people are always giving you money at the wrong time and taking it away at the wrong time. So they're very, very difficult to manage. And this is a really important point. So Peter Lynch, when he was annualizing 29%, conducted a study, and he wanted to know what the average investor in Magellan had earned. And what he found was that the average investor had earned 5%, and many had actually lost money. He was annualizing 29%. So again, investors are constantly doing the wrong thing. When a manager runs up, they give them money. When the manager draws down, they take it away. And that's how the average investor earned 5% or lost money when the product they were investing in was annualizing 29%. Now, this is something I want you to remember. What is a really easy way you could have outperformed Buffett, Lynch, or Templeton sitting at home in your pajamas eating potato chips? Well, the way you could have done it is you would have simply added money every time they had drawn down. Arithmetically, you would have a higher return than these managers. So investing can be very complex, but it can also be very simple. And I always tell our investors when they walk through the door, this is a partnership. I am a tool in your toolbox. But if you give me money after I've had a big run up and you take it away when I draw down, together we're going to produce a really poor return. So the investor has some responsibility in this. If you're not good at controlling yourself, you should use a dollar cost averaging program or something like that to remove your emotions from that process. But I think that's really, really important to remember. So you can invest with the best manager in the world, but if you can't control yourself and you're constantly putting in money at the wrong time and taking it away at the wrong time, you're going to have really poor returns. But there is a reason for your poor returns, and you all have an excuse for your lousy investment returns. That should make you feel pretty good. There's a biological reason for this. So researchers at the University of Pennsylvania have found that the human retina can process 10 million bits of information per second. This is about the capacity of an Ethernet connection. Your other senses add about 1 million more bits of information per second. So the total bandwidth of the human brain is about 11 million bits of information per second. But the human, only about 40 bits of information make it to the human conscious. So the way the brain works is it's typically taking this information in and processing it in a region known as the prefrontal cortex. The prefrontal cortex is involved in decision making, complex cognitive behaviors, self-control, but it's very analytic. And it's a very slow part of your brain. So when you think of the brain, you can think of the brain as sort of taking in information through a fire hydrant. And the prefrontal cortex is like a slow, leaky faucet dripping out. Now, when your eyes and ears sense danger, or if you turn on CNBC and the market's crashing and they've always got this fabulous music playing in the background to really heighten your anxiety, the problem is that your brain bypasses the prefrontal cortex and sends information to an area called the amygdala. And the amygdala controls your fight or flight response. And the amygdala is a much faster processes information much faster. And to do so, it relies on something called mental shortcuts, or behavioral finance experts call this heuristics. And it's these mental shortcuts that oftentimes get investors into a lot of trouble when they're investing. So I think reading about behavioral finance is really fascinating, and there are a lot of books out there, and I would encourage you to pick one up and read about it, because once you're aware of these mental biases, you actually become a better investor. You know why you're reacting that way to really scary information.